Okay, so this is joint work with Alessandro, who's an excellent PhD student at the University of Geneva, and Fabio, who's also at the University of Geneva. They may join later on. Fabio is currently on a train, so I will see whether he will make it. And you should feel free to just ask me any questions you have. Okay, so let me start. So what's the main idea of the paper? The main idea is going to be to extract measures of expected returns. Now, as you all know, expected returns are not observable. So the way we think in asset pricing about extracting expected returns is usually to use asset prices. So either, for example, you could use asset price, you could use valuation ratios, or we could use predictive regressions in order to get a measure of expected returns. Now, if you use, and I will show you how people have done that in the past, if you use option prices to extract a measure of the expected return, we usually find that these measures have a high volatility, they're counter-cyclical, meaning that they're high in bad times, and that they're not granular in the sense that we usually have one measure of expected return. Now, why is this important? This is going to be important because I'm going to show you how to extract expected return measures on an investor level. Another thing is that these measures that are extracted from asset prices usually do not align with survey data because survey data has different properties from the ones that we see from prices. So what we want to do in this paper is we want to argue that holdings data or buy and sell orders of investors are very informative about their beliefs. And in particular, if you combine asset prices with holdings data, we get expected market return measures, which are very different from the ones if you would only use asset prices. So let me explain how people have extracted expected measures of returns from options data. So this goes back to a paper by Ian Martin in the QJE. So let me just walk you through the assumptions, and then I will tell you how our paper is going to deviate from the approach that's taken in that particular paper. So in that paper, he assumes that there's a rational one-period log investor. Now, because we assume logarithmic utility, we know that there has to exist a positive stochastic discount factor, which is going to be given by the inverse of the return on the portfolio, which combines the tradable securities with the maximum expected log return. So the stochastic discount factor is going to be denoted by M, and it's just going to be the inverse of theta prime, where theta prime are going to be the holdings, and R are just going to be the returns of the asset that this investor holds. Now, we know that this portfolio is growth optimal since it maximizes the expected long-run growth of investor wealth. So how do we now extract a measure of expected returns using the stochastic discount factor? Well, that's very simple. You can do it in one line. You just have to define a change of measure. So dq, so q is going to be the forward risk neutral measure over dp, where p is the physical measure, is going to be equal to the stochastic discount factor. In that case, if we want to calculate the expected return under the physical measure, it's just going to be the expectation under the forward risk neutral measure of M inverse times the market return. Now, what does Martin assume in this paper? He assumes that theta is equal to 1. So what is the assumption here? He assumes that the investor holds 100% of our wealth in the market index itself. So implicitly, what he assumes is that options are redundant. Okay, so now, since we are in a virtual derivative seminar, you should all be outraged. So how is it possible that options are redundant? Anyways, if you make this assumption, it follows immediately if you just replace theta by 1 and R by Rm, you find that the expected return is exactly equal to the risk-neutral variance. So what he argues is that you can use this measure, what he calls the simple VIX squared, as a measure or a lower bound of the expected return on the market. Let me show you how this looks like in the data. So in the data, if you construct this from the cross-section of options, so you guys know this much better than I do, so you can obviously recover the risk-neutral probabilities from the cross-section of options, and you can calculate this SVIX square. And what you see here is exactly what I told you in the very beginning. If you look at this lower bound on the expected return on the market, it's very volatile, and it spikes in bad times. So these gray bars are NB or recessions. It's also highly persistent. So what is the average expected return? It's 8.2% in the sample that I'm studying here. Okay, so another way of how you could calculate expected returns is that you can just go and ask people, what do you think is the expected return on the S&P 500 for 2025? Now, there are many different surveys out there. So here I'm just showing you this picture from a working paper by Wang. And what he does is that he just assembles this data set of different surveys. And what you see here is that survey data shows very different properties from the ones that we just saw using the SVIX. And in particular, what you see here, for example, is that the expected returns of this red line, which are consumers, seems to drop in bad times. Okay, so in asset pricing, we always think that risk premium should go up in bad times, but what you see here is that if you actually go and ask people, it seems that expected returns are actually pro-cyclical rather than counter-cyclical. So what is the key idea of our paper? So the key idea of our paper is really very simple, and I can just show it to you in this equation here. So what is this equation? This is the recovery equation that we're going to use in our paper. So on the left-hand side, we have the subjective probability PI. So now everything is going to be indexed by I because I'm going to do this on an investor by investor level. We know from this triangular relationship that this should just be the risk neutral probability Q divided by the stochastic discount factor MI. So what we're going to do in this paper is that, as before in the Martin paper, we're going to recover Q from the cross-section of options, but we're now going to assume that options are going to be non-redundant. In fact, as we're going to argue, there is a very large market for crash insurance via, for example, out-of-the-money put options, and that's very informative about the beliefs, the subjective probability that these investors have. So what we're going to do is that we're going to use holdings data that we observe, and we're going to characterize the stochastic discount factor MI, which is, again, just going to assume that we have log investors. It's just going to be the inverse of theta prime times R, but now we actually do observe the thetas, and we observe the returns, so we can just plug in what we see in the data and recover the stochastic discount factor. So what we can do is we can recover subjective returns and risks. So I'm not just going to look at the first moment. I can look at the second moment, third moment, and so on for granular investors in real time. So I can tell you in real time what is, for example, the Sharpe ratio of market makers in the market for S&P 500 options. Okay, so what is our contribution? We have two types of contribution. The first one is going to be theoretical. So I'm going to show you how to recover a stochastic discount factor without making any assumptions about what the optimal holdings should be. I'm going to show you how we can identify beliefs of heterogeneous investors, because now we're going to have different types of investors. I will show you that if you have a heterogeneous agent economy, the SVIX is actually going to emerge as a consensus belief in this economy. And last, we also have an extension in the paper to the case where we have measurement errors and convex frictions, but in the interest of time, I'm not going to show you these results. Empirically, I'm going to show you that the size and cyclicality of expected returns really depend on what agents hold in their portfolios. Subjective expectations may vary wildly across different investor classes, and I think we can provide a rationale of why survey data can look so different across different investors, but also why it looks different from examples from price-based measures. So let me show you the theory, and the theory is very, very simple. I can show it to you literally in one slide. Before I go there, I want to show you a very simple hypothetical example in order to motivate why it makes sense to look at holdings data. So we know that institutional investors, such as hedge funds, often hold out-of-the-money puts as an insurance. Now, because options are in zero net supply, there has to be someone who sells these options, and these are usually market makers. So they're going to sell crash insurance to hedge funds. So what does that mean? While hedge funds now have less exposure to the market, market makers are now more exposed because they're short to put options. Now imagine hedge funds hold a portfolio which consists 90% of holding their wealth in the index and 10% in either at the money or out of the money puts. What would you expect the expected return to be? Do you think it's higher or lower than the expected return of an investor who has invested 100% of their wealth in the S&P 500? Well, quite obviously, you would argue that if you hold a put on the index, your expected return should be lower compared to the expected return of an investor who is 100% invested in the S&P 500 itself. So what am I plotting here? So here's a time series from 1996 to 2022, and the black dashed line is what we call the benchmark expected return. So that's Ian Martin's expected return, assuming that an investor holds 100% of their wealth in the S&P 500. The yellow line is an investor who holds 90% in the index and 10% in at-the-money puts. And the gray line is 90% in the index and 10% in out-of-the-money puts. So what you see here is that even if a small fraction of your wealth is invested in options, you get significantly lower expected returns. In fact, these expected returns can actually be very negative sometimes, and there are periods of where the expected returns from this investor is negatively correlated with the expected return of an investor who holds 100% of her wealth in the S&P 500. Now, what does this imply for the stochastic discount factor? So what I'm plotting here is just the shape of the stochastic discount factor. So on the x-axis, we have the excess return. So that's the only state variable which drives the stochastic discount factor. And on the y-axis, I plot the ratio between M0, where again, M0 is just the stochastic discount factor of an investor who holds 100% in the S&P 500, and what we call M star, which is the investor who also invests in either at the money or out of the money puts. So what do you see here? Very intuitively, if you have very negative returns of say minus 20%, this ratio here would increase a lot. Why? Because the marginal utility of an investor who holds out of the money puts is obviously very different, is much lower than the marginal utility of an investor who holds only the index. Now you may say, maybe this looks different if we look at calls. So imagine you have an investor who is very aggressive and buys at the money and out of the money calls on the S&P 500. What would you expect? Obviously, you would expect the expected return to be much higher because your exposure to the S&P 500 is now much bigger. So if you add calls, you have higher expected returns, and the volatility of your expected return time series would also be much larger. Why? Because you have much more leverage in your position than if you only hold the underlying. Okay, so this was just the motivation for what we're doing in the paper. Now, what I'm going to do in the paper is that I'm going to use actual data. So we observe what people actually hold, and we're going to use that to recover these expected returns. So here's literally the theory in one slide. So what is the economic environment? So we're going to assume that investors have access to three different assets. The first one is going to be a risky asset, which is going to be the index. Investors can trade a continuum of options, which are written on the risky asset, and the risk-free asset. So let me denote by this bold RE. This is just going to be the excess forward return on the index and the options. So we're going to assume a heterogeneous, unconstrained log investors. So now we're going to index everything by I because we're going to have different investors. I'm also going to assume that they're log, but I can show you that this is just going to provide us a lower bound. So in that case, again, we know that the stochastic discount factor has to be the inverse of the growth optimal portfolio, where theta I are now going to be the portfolio weights both in the market index and the options held by investor I. By no arbitrage, we know that the expectation for investor I of MIRE has to be equal to 0. Again, we can define a change of measure, dq over dp. We can do the change of measure, and we find that the expected return on the market for investor I is now just going to be this expression here, where now, different from before, we're going to assume that theta is not going to be equal to 1, but now actually this investor is also going to hold different options. Okay, so now the last thing I want to do is I want to show you how we can understand the size of the expected return and the cyclicality properties of the expected return as a function of these options holdings. For this, I'm just going to decompose my measure of the expected returns in two different components. For this, let me define theta 0 to be the fraction that's invested in the index, and 1 minus theta 0 is going to be the wealth invested in options. Omega is going to be the observed portfolio weights in the options. So we're going to use the CBOE open close database in order to see what these omegas are going to be in the data. So we can rewrite our main equation as follows. So the expected return on the market of investor I is going to be his or her investment in the risk-free rate, the investment in the index, which is going to be multiplied by the risk-neutral variance, as in the Martin paper, and 1 minus theta 0 times the covariance between the option portfolio, which is now going to be omega prime times R, and the return on the market. So this R here, okay? So now you can already see how the cyclicality and the size of the expected return can change relative to the case where the investor is 100% invested in the index. If the investor is 100% invested in the index, theta of 0 is going to be equal to 1, so the expected return is just going to be the risk-neutral variance. So this is always going to be counter-cyclical. Why? Because risk-neutral variance goes up in bad times. However, this covariance term here can be actually negative. And why is that? For example, imagine as before, an investor holds portfolios of puts. Put prices go up when the market return goes down. So the covariance between the option portfolio and the index can actually be negative, which means that the expected return of this investor can actually turn pro-cyclical instead of counter-cyclical, okay, depending on obviously the size of this covariance. Okay, so last thing, and then I'm going to explain how we're going to do this with heterogeneous agents, is going to be many people, when you present these slides, are going to argue, well, it's unrealistic to assume that market makers or sophisticated investors are log investors. So maybe you want to argue that log utility seems unrealistic. Now we can show that even if there's an other utility function, the log utility case is just going to be a lower bound on the expected return of this investor I. So for this, suppose that the investor has some other utility function with some unknown belief P star. We're going to say that the negative covariance condition holds if the covariance between the stochastic discount factor of this investor with this other utility function times the portfolio holdings and the returns and the market return itself is negative. Now, Ian, in his QJ paper, he argues that in lots of asset pricing papers and in the data, you actually find that this covariance here is negative. So this seems to be like an assumption which seems to make sense. So in that case, you can show that the expected return that we just recovered in the previous slide, so this would be the expected return of investor I, is just going to provide a lower bound on whatever expected return with this unknown utility function of this other investor is going to be. And why is that? Well, if you just rewrite this expression here, you can show that what I have in red here is just a change of measure from the forward risk neutral probability Q to belief PI. So even if you don't believe that market makers or investors have log utility, it still makes sense to look at the log utility case. Why? Because it just provides a lower bound on what the expected return should be. Okay, so now the last thing I want to show you for the theory is how you can aggregate now these heterogeneous agents to a consensus belief. So now assume we have n different investors who allocate their wealth to the aggregate index, which is going to be in positive net supply. and a portfolio of options, which are going to be in zero net supply. RI is going to be the forward return on I's investor wealth over horizon 0 to T, and R is going to be the forward return on the market index. So what is the market index? The market index is just going to be a wealth-weighted average of the returns RI. So we're going to weight over all agents I. So we're going to define a consensus expected market return, E bar, which is just going to be this wealth-weighted average of the expected returns of all the agents in this economy, EI. So that I'm going to show you the main proposition. So if you assume that there's a subset, so there's an investor J who is a log investor, and this log investor is optimally invested in the index and in the option market, you can show that agent J's expected market return is going to be given by this expression here. So this expression here looks exactly the same as the main equation I showed you before. So the expected return on the market of agent J is just going to be the risk neutral variance of the market return plus the covariance terms between the returns of investor J and all the other investors in the economy. Now, if we assume that all investors are log investors, well, what's going to happen? In this case, we can show that the consensus belief in this economy is just going to be the risk neutral variance. So where does this result come from? So this comes from the fact that options are in zero net supply. So because in equilibrium, the market has to clear and is in zero net supply, this covariance term here is going to disappear. So what does that mean? It means that the SVIX is going to emerge as the expected consensus expected return in an economy where all investors are unconstrained log investor and the wealth is optimally invested in the index and in the options. Now, of course, in real life, we don't expect these two conditions here to be satisfied, but I'm just showing you the SVIX is the consensus outcome in a heterogeneous agent economy if everyone is a log investor. Okay, so last thing is, of course, we can use our framework not just to extract subjective expected returns. What we also can do is that we can recover subjective risk. So we can also look at higher order moments. And this is very simple. So instead of multiplying by R, you just multiply by R squared. So we do that. So the expected subjective risk of agent I is now going to be the forward risk neutral expectation of M inverse R squared. So again, if we assume that the investor is fully invested in the market, so if theta is equal to 1, subjective risk of agent I is just going to be the risk neutral skewness in the market. Okay, so but again, in our setting, theta is not going to be equal to 1. It's going to be different from 1. We're just going to look at the data and we're going to extract investor level measures of subjective risk. Does anyone have any questions?
No question in the chat right now. You're so clear.
Okay. I'm sure that's the case.
Officer, there's someone on the tracks. I'm trying to arrange the next train, but the conductor, he's not answering.
Call the control office. Tell them to stop all trains on this line.
I think that was not for us. So just a quick one then to change from the train thing. So I was just surprised to see the NCC show up at the individual level. So I mean, it's already. How should I kind of get a feeling, an intuition for that? I mean, I'm not very good at doing maths on the fly here. So I understand why it works at the aggregate level. Can you give us kind of a bit of guts feeling why it works at the individual level?
So this is just for the investor in this economy. So with stochastic discount factor MI.
Yeah, but okay. I'll play with the maths later. It's just like it feels like.
So the math is exactly the same.
okay, so if I were to take a limit, for instance, of an investor who's fully invested in an out of the money put, and another investor that is fully invested in an out of the money call, both would respect the negative covariance condition. There's a little
So this
I
is it.
here. Little I is the investor, right?
That's investor level, exactly, yeah.
Okay.
Andrea, could you clarify for us what is heterogeneous here? It appears that the investors all agree on the expected returns on the individual securities, and the reason that they have different expected returns on their portfolios has something to do with risk aversion, but they're all log investors. So I'm a little confused about what you're assuming people agree on and what you're assuming that causes their heterogeneity.
That's a very good question. So what causes heterogeneity? So why are we indexing this by I? We're indexing this by I because the portfolio holdings are going to be at the investor level. Now, the risk aversion, so they're log investor, as you say. So the risk aversion is somewhere in the holdings, right? Because if you hold obviously an out of the money put, it tells you something about their risk aversion relative to someone who sells this out of the money put. So this will be captured in theta I. So the heterogeneity comes from the holdings data itself.
Okay, but so for a specific stock, let's say Tesla, right? Everybody agrees on R of Tesla, expected return on Tesla. And the reason that they have different portfolios is that they have different risk assessments, is it?
So actually that's not true. So
Okay.
I don't know about Tesla, but if you
Yeah,
if you go and ask people what is the expected return on the S&P 500, you actually find that people give very different answers, right? So even the properties of the expected return across different like buy side versus sell side analysts looks very different. Some people say it's counter-cyclical, some people say it's pro-cyclical, and so on. So I don't think people agree I don't think anyone knows what the expected return on Tesla is, especially after
well,
today. What the
understandable.
expected
I
I'm
thought
trying
his
to figure out
question
your
was in
model.
your model.
You got a vector of R's, and everybody agrees on the vector of expected R's, or they do not.
So which R are you? So this R here?
Okay, yeah, I like that R.
Okay, so this is so this is going to be at the investor level. So market makers will have a different expectation on R than hedge funds. So that's exactly our point. So because market makers are going to be short on average, so they're selling insurance to the market, their expectation of R is going to be different than, for example, hedge funds who are going to be long the insurance. So in fact, I'm going to show you different time series depending on the investor. It's going to be at the investor level. So they're going to disagree about what the expected return is on the S&P 500.
But in the equation one, it's only the theta I that seems to be distinct among the different investors.
Yes, so the prices obviously are the same for all the investors. The only thing that's going to be different is going to be the holdings data, the holdings.
Okay. All right. Thanks.
Okay, so let me then talk about the data. Okay, so what do we do? So we have data which starts in January 1996 and it ends in December 2020. We're going to use the CBOE open close database. This is going to provide us with buy and sell orders for two types of investors. So we're going to see customers. So these are going to be retail and institutional investors and market makers. So because this database comes without any pricing information, we're going to match the buy and sell orders with prices from the option metric database. So the data is daily. However, because we don't want to have very noisy measures of expected return, we're just going to aggregate our daily measures to monthly measures. And we're going to fix the horizon of these options to 30 days. Why is that? We obviously observe options with many different maturities, but at least we didn't find that the market is like super liquid for very long-term options. So we didn't feel comfortable like using very long-term options. So for the results I'm going to present you here, I'm just going to focus on 1 month options, which means that we're going to talk about expectations about what the return is going to be over the next month. Okay, so here's just some summary statistic. So these are customers' net demand. So what does that might mean? Net demand is just going to be buy minus sell orders. Sorry. So here we have calls. K over S is going to be the moneyness, and here we have the holdings, and here on the right hand side we have the puts. So just 2 things. Customers are long puts and they're short calls on average. How do we see that? The holdings data here is negative, whereas if you look at the puts, you find that the holdings data here are very positive. Now, what is special about our holdings data? So usually when we talk about demand-based asset pricing, people always think in terms of flows. So how much do you buy and sell every day? Now, in our theoretical framework, the theta really captures the aggregate positions, so the aggregate wealth that the investor has. So different from the previous literature, which has looked at flows, so buy minus sell on a day-to-day basis, we aggregate all the holdings because we can track. So every option, when it starts, it has like some identifier, and then we can track the option until it expires. So we can track really the holdings of these investors option by option and then aggregate their portfolios. So how does this look like in the data? So what I'm showing you here is this is the customers holding in out of the money puts for what we call mild out of the money puts and deep out of the money puts over time. And what you see here, so since these are customers, we usually expect that market makers are net sellers of crash insurance to the public. So there's this paper by Garliano, Pedersen, Pottishman. Other people have shown that in the data. So indeed, on average, customers are long puts. Now, what you see here is that this can change over time. So in particular, sorry, what you see here is that in 2008, customers were actually net sellers of deep out of the money puts to market makers. Now, interestingly, this was really a phenomenon of 2008 and does not extend, for example, for during the COVID period, when you see nothing basically happening in this out of the money put market. Now, this was for puts. What about calls? So if you look at the time series of calls, again, we have mild out of the money calls and deep out of the money calls. What you see here is that most of the time, they're actually net sellers on S&P 500 puts. So in particular for these mildly out of the money calls, however, what you see here, interestingly, is that before the financial crisis in 2008, people were actually, customers were very long on these deep out of the money calls and then turned again negative during the 2008 crisis. Again, there was nothing happening during COVID with these call options on the S&P 500. Okay, so now there's one issue. So when we talk about these thetas, I talk about how the wealth is allocated between the index and the option portfolio and the risk-free asset. Now, while we observe the option holdings on the S&P 500, we do not observe how much, for example, Citadel holds in the market index. Okay, so I have no idea what their exposure or the true exposure in the S&P 500 itself is. And as Neil told me when I presented this paper 1 year ago in Cancun, I also do not know their other exposures to the S&P 500, for example, in SPY options. Okay, so now what we have to do is that we have to make some assumptions. So obviously I cannot like account for every possibilities or every exposure that has to the market, but we can make some assumptions about what their holdings in the index, for example, is. So the assumption we make is the following. So if we recover the stochastic discount factor using this holdings data, not every stochastic discount factor that we recover is actually an admissible stochastic discount factor, meaning that it's a positive stochastic discount factor. So what we do is that we allocate theta 0 in the S&P 500 and 1 minus theta 0 in the observed portfolio of out-of-the-money options and the rest in the risk-free assets, such that the stochastic discount factor that we recover is an admissible stochastic discount factor. What does that mean? It means that at any point in time, we make sure that the no arbitrage condition is not violated, and the investment in the index is such that this investment is exactly that the stochastic discount factor is positive. So what does this alpha capture? So if alpha is equal to 1, this would mean that the investor is 100% invested in the index. And if alpha is equal to 0, we get exactly the value, the minimum value in the index, such that we recover an admissible stochastic discount factor. Okay, so now I show you the main result of the paper. And the main result of the paper is what is the expected return on the market for these customers, which are both retail investors and institutional investors. So here in this table, I just show you a summary statistic. So this is the mean, this is the standard deviation, the autocorrelation, and the correlation with the benchmark. So alpha equal to 1 is the Ian Martin S-VIX. So that's under the assumption that the investor invests 100% in the index. In this case, as I already mentioned, the average expected return on the market is 8.2%. Now, what you see here is that the size of the expected return for these customers is significantly smaller as we increase the investment in the options. And what we also see is that the volatility of this measure becomes significantly bigger as we increase the investment in the options. And why is that? Well, options are a levered trade. So during normal times, you would have much higher volatility in these expected return measures than, for example, in the benchmark if you're only exposed to the S&P 500. What we also see here in this column here, there is the correlation between our measures of the expected return and this S-VIX. And what you see here is that this correlation can be super tiny. Okay, so what does that mean? It means that the time series properties of the expected return can be very different from the benchmark, where you assume that everyone invests 100% of their wealth into the index. Here's the picture for different alphas. So alpha equal to 1, again, is the benchmark, and alpha lower than 1 just means an investment in the option portfolio. What you see here is already that the expected return is significantly smaller. Okay, so even if you have a very small investment in the index and you have an investment in the options, what you see here is that the expected return actually can turn negative. So this was for customers. What about market makers? Now, for market makers, we're going to tweak a little bit the wealth allocation. So we know, for example, that, or there's some literature which shows that market makers are delta hedged. So what that means is that they always take an offsetting position in the index such that the risk or the delta risk on their portfolio is equal to 0. And that's what we do here. So in order to recover the expected return of market makers, we assume a delta hedge portfolios, and that's going to be the investment in the index. Again, I'm giving you the average expected return, which has to be the same for the benchmark. But now, again, we're going to vary the amount you invest in the options. And what you see here is that the correlation with the benchmark itself is much higher. Okay, so it stays almost above 90–80%, even if you have an investment in the options portfolio itself. And this is what we see here. Okay, so these are time series of the expected returns of market makers. So SPX market makers seem to have an expected returns, which is very highly correlated with the SVIX itself. Sometimes it can be a little bit smaller. Sometimes the correlation can be negative, but most of the time this correlation is almost 99%. Okay, so I'm almost getting to the end of my presentation. So one of the last things I want to show you is because we have a heterogeneous economy with two investors, so we have market makers and customers, we can look at the belief dispersion. So it doesn't make sense to look at the consensus belief, because the consensus belief in this economy, as I showed you, is just going to be the SVIX itself. And the reason for that, again, is just because options are in zero net supply. So a more interesting measure to look at is the dispersion around the consensus belief. So what we do is that we calculate the dispersion from the consensus belief. So we're going to look at the absolute deviation from each investor's expected return from the consensus belief, and we scale this dispersion by the risk neutral variance because we don't want the dispersion to be contaminated mechanically by variations in the volatility. So if we calculate these measures, what do we get? So we get a measure of countercyclical belief dispersion. So we see that belief dispersion is higher, for example, during this crisis, and it increases as the investment in option increases relative to the index. So if you remember, if you look at the holdings data, we saw that the holdings data was spiking either negatively or positively around crisis. So the more obviously dispersed these option portfolios are, the more the dispersion is, the deviation from the market, from the benchmark consensus belief is going to be bigger. Okay, so last thing, I want to show you measures of subjective risk. So this is just mislabeled. So this should be subjective risk. Remember, subjective risk is just the inverse of the stochastic discount factor multiplied by R squared. So we can recover customer's subjective risk. So what you see here, the black line is the benchmark, 100% invested in the S&P 500. The orange and the red line is in the option portfolio. What you see here is that subjective risk is higher for people who hold an option portfolio than for an investor who only holds the index. Why is that? Well, again, the intuition is the same as before, because options are a levered trade on the underlying. Obviously, the risk is higher, which means that the volatility is going to be higher. And when the benchmark spikes, so when the underlying spikes, they all co-move together. So they're exactly going to coincide at the same time. What about subjective Sharpe ratios? So we can just take the expected return that I showed you before and divide by subjective risk. So this here will be the subjective Sharpe ratios of institutional investors in the SPX market. What you see here is that the Sharpe ratio is actually very volatile, and it can often be very negative. Okay, so why is this the case? Well, as I just showed you before, the deviation from the benchmark is the largest during normal times. And why is that? Again, because options are levered trade on the underlying, and hence in that case, you have more volatility, which causes the Sharpe ratio to be much more volatile in that time. Okay, so as a last evidence, I want to go back to what I did in the very beginning. So remember, in the very beginning, I was showing you measures of expected returns from asset prices. And I was telling you that if you compare these measures of expected returns to survey data, you find that the properties of survey data and expected returns from prices are very different. So what we do in the paper is that we look at the co-movement of our expected return measures with different survey measures. So here I have 3 different survey measures. I have the Livingston survey measure. I have this CFO expected return measures from Graham and Harvey. And I have the Nagel and Shu expected return measures, which are individual, so household level expectations of the S&P 500. Now, they're not exactly one-for-one comparable because most of these surveys ask about the 1-year horizon. But what you see here already is that the correlation with the Livingston survey is significantly higher than the correlation with survey measures, which are from households. So to give you the numbers, the correlation with the Livingston survey is plus 22% for market makers and 10% for customers, where it's actually negative for the Nagel and Shu survey measure, which is just an aggregate of household level expectation. Now, does this make sense? I think it does. Why? Because the Livingston survey are professional forecasters, which are highly sophisticated, which is the same as our customers. So our customers are institutional investors, whereas this other measure is really a measure of retail investors or household. And for this, we actually find that the correlation is negative. Last thing, what about predictability and cyclicality? Remember, the SVIX is highly countercyclical, so goes up in bad times. So if we take standard predictors of expected return So this would be the wealth consumption ratio. This is the dividend price ratio, and some measures of cyclicality. So that would be industrial production, the term spread, and the default spread. What you see here, basically, so these are many numbers and it's very small, but the main message here is nothing is significant. So what this tells us is that the expected return measures that we extract from the holdings data together with the prices are significantly less cyclical than if you just use prices themselves. The only thing which loads in a significant way on our measures of expected returns are past returns. So these are 12-month past returns, and what you see here is that the loading is negative. So low returns imply high expected returns going forward. Okay, I think Neil told me 50 minutes, and I think I'm at 50 minutes. So let me conclude. So what we want to argue in this paper is that holdings data can affect the stochastic discount factor, and hence measures of recovered moments significantly. Time series properties of beliefs vary across investors, and it depends obviously on their portfolio. And in particular, what we argue is that the size and cyclicality patterns depend on the holdings themselves in line with the survey data. What we can show is that you can recover a rich belief heterogeneity just by looking at the holdings data together with prices. Thank you so much for being an audience and being here. If anyone has any questions, I'm happy to answer any questions.
Yeah, so thanks very much, Andrea. So right now, I'd like to invite anyone who has a question to feel free to unmute yourself and use your microphone to shout it out. While you're thinking about your questions, I'll jump in with one of my own. Could you go back a slide or two to the slide where you compared the different, that one, thank you. So my question is, why do customers and market makers have such different beliefs? Now, I understand that in your analysis, they have different beliefs because they have different holdings, and your analysis maps their holdings to their beliefs. I mean, I understand, but take a step back from your, I'm thinking about take a step back from your analysis. I think sophisticated customers and market makers will see much of the same information. You know, sophisticated, you know, some hedge funds and institutional investors and market makers, there'll be people who've had certainly overlapping training. So what is it? I understand in your model, they have different beliefs because they have different holdings. So according to your model, they must have different beliefs. But out there in the world, why do people who maybe communicate with each other and see the same information have such different beliefs?
Okay, so that's an excellent question. So I think this is just like the business that they're in, right? So I think Citadel's business is to make the market, and they make money because they are market makers in the option market, whereas a hedge fund does many other things, and their business is to do a long short strategy, and then they just hold some puts for diversification or lowering the risk or things like that. So I think it's just the business line which is different between market makers and institutional investors.
So okay, that your answer doesn't surprise me, but if it's because they're in different businesses, let me maybe modify that a little bit and say they're in different businesses and they have different incentives, so they do different things and have different holdings. But is different beliefs the right way to think about that then?
I mean, first of all, I want to emphasize, I mean, I'm not arguing that we recover Citadel's expected return on the market.
I think Andrew's in Norway. I think we lost you for about 5 seconds. Could you back up?
I'm sorry, but yeah. So I want to emphasize that we don't want to make a point or case.
We lost you for about 10 or 15 seconds. Could you rewind about 10 or 15 seconds? We don't know what you were saying.
So I want to emphasize that we actually do not claim that we recover Citadel's expected return on the market. What we do is that we recover a possible belief given the snapshot we have on their portfolio. So I 100% agree that most likely the views they have about the market can be very similar because they went to the same schools and things like that. But all I'm saying is that this is one possible expectation that we recover given the information we have about their holdings.
Okay, thank you. Anyone else? Feel free to jump in.
Okay, I'll allow myself, bringing you back to a DNCC question. I think I have kind of a way to kind of illustrate a bit better what kind of caused my uneasiness, and I think it's not unrelated to Neil's question. So in the equation where you present the NCC, there's this theta I, right? And yeah, but at the investors level, right?
Mhm.
Okay, sorry. So there was an equation where the NCC was presented with theta I, right? Which was the theta of the investor.
It should be
right?
an I, yeah.
Yeah, okay. So let's say, for instance, that we consider Ian Martin's investor. Theta I is essentially a 1 on the market and 0 everywhere else. Yeah. Now let's say that investor J is having a -1 on the market and zero everywhere else. So theta J is essentially minus theta I. Correct? So, there's a minus sign that shows up in the covariance here. And you're telling me that the negative conditional covariance condition still holds. So this minus sign has to be undone completely by what's happening in the stochastic discount factor and the expected return vector of this investor. It seems like a very demanding condition. It's already somewhat of an issue with the NCC in Ian's paper, in the sense that you have to make the argument that it's relatively tight on top of being always negative for being able to compare the SVIX with everything else. Now here, if we want to compare two investors, I don't know how tight it's going to be on one investor and not tight on the other. So maybe the reason why those beliefs look so different, it's because maybe it's much tighter for one than for the other. So you see, I think all of these things are somewhat related. Am I wrong?
Yeah, so first of all, so these whole things, you have to assume, so this is a log investor, and we assume that this is the growth optimal portfolio, right? So which maximizes the long-term growth of wealth of this investor. So it cannot just be anything, right? You have to assume that this is the optimal return that this investor generates. So not any portfolio.
I thought you had said that when we, the reason why you need to look at the NCC is because M star would be what happens if it's not a lug investor, right?
But then it's a different utility, right?
Exactly. So what I'm saying is, you're telling me that I can look at everything as a lower bound as long as I believe that this M star is respecting the NCC. M star is not lug utility in that case. It's whatever the actual utility of the investor is, right? So I don't know. It feels like this kind of loop here has to be closed somehow in terms of how tight the bonds are on different kind of investors. But again, it's more a comment than a question. Maybe I'm completely mistaken.
I mean, he shows that in the data. Sounds great.
Hello, I'm Fabio. Can I just jump in 1 second?
Yes, of course.
On the issue. So the main idea in the MPs is, of course, is that ideally we don't want to go incredibly away from the benchmark of Martin, right? So the point is that if you have a relatively small percentage of investment to the options, you already can get a lot of deviation in terms of the belief formation. So if you look at, for example, the customers, we are talking about percentage investment in the market of 98% in the kind of benchmark example we do. So if this NCC condition is a bit, let's say, smooth in terms of what is the investment condition in the neighborhood of the Martin case, you would hope that things should not change too much, but what we show is actually that a very small perturbation of that investment can really change a lot the perception of the belief. And I think that's the main point with the paper.
Okay, so you're telling me not to worry about these extreme -1 cases.
Yeah, because right now calibration, we don't take them, right?
Okay, okay.
All right, other questions? Last chance to ask a question. Last chance to tell Andrea she's wrong.
You can also email me to tell me I'm wrong.
Thank you so much, Andrea. This was a very interesting talk. Thank you for your time at this late hour of the night. I hope you'll be able to join us in a couple of weeks when Fusini-Chabillo is going to give us the next virtual derivatives seminar. And everyone, thank you for joining us. And I also hope to see you again in a couple of weeks. Ciao, ciao.
Thank you very much.